Hi, ladies and gentlemen. My name is Greg McDaniel, and I'm with the McDaniel Callahan Real Estate Team with J. Rockcliffe Realtors. This is James Callejas. He's with IPX Exchange. They specialize in 1031 exchanges and a multitude of other very, very complicated tax questions that we are going to be covering in the next several series. Today, we're going to be talking about one of our first tax issues, and it's going to be what Obama signed into law in December 17th of 2010. And it has to cover four main topics. And the first that we're going to cover today is going to be capital gains. So, what changed?
Nothing. It's interesting that you asked that question about what changed. We all thought something was going to happen. Everything was put in place that the capital gains rate were going to increase or actually revert to back what it was in 2004, but we actually stayed at 15%, did not go to 20%.
Really?
And that's going to affect any long-term capital investment as well as any dividends, so that will be for part of your real estate portfolio as well as your stock portfolio.
Interesting. So we haven't changed, but we haven't gotten worse, but we haven't gotten better.
Right.
Okay. So that's a good thing. Personal income tax. Last time I checked, we're at about 40%. Is that still correct?
You see, we were supposed to be at 40%. We actually stayed at about 35% as the top bracket. What they wanted to do, the Democrats wanted to increase the tax brackets. The Republicans wanted things to remain the same. We eventually came into a lame duck session.
Okay.
And what we're talking about right now, everything is going to remain in effect for the next 2 years. So what President Obama signed off on December 17th is the agreement that the Republicans and Democrats came to for the topics that we're going to be discussing today. So until December 31st, 2012, these are the rates that we're looking to expect. Income tax rates to remain the same, anywhere from 10 to 34.8%, and the federal capital long-term investment to remain at 15%.
That's good news.
It's good news, unless you like giving money to the government.
No. I like keeping my money in my bank account. I'm sure you guys like keeping your money in your bank account too.
I know I do.
Speaking of keeping money in accounts, estate taxes. Where did we shift? We still about $1 million?
This one was just so interesting to me because it all started in 2002. President Bush put into effect the estate tax limit. So in 2002 it was $1 million. And if I were to pass away and the beneficiaries to my throne came into the estate, then anything up and above $1 million, they're taxed 45%. So $1 million and $1, 45 cents of that would go back into somebody else's pocket. Each year that increased, and in 2009 we maxed at $3.5 million. And what was in place was that in 2010 it was going to become unlimited. So certain people, namely Michael Jackson and George Steinbrenner, took advantage of dying in 2010, or at least the beneficiaries to their estate took advantage, and it was unlimited. The caveat was that they limited the step up in basis to $1.4 million for all of your real estate holdings, not just one. So put them all together, and the step up in basis is limited to $1.4 million, whereas in every other year it's a full step up in basis. What that means is when you pass away, you bought the property for $100,000. It's worth $1 million today. The beneficiary gets that basis stepped up to $1 million, so if they were to sell it the next day, there is no gain. If I own multiple real estate holdings and it's more than 1.4, the basis is not going to be fully utilized, and they're going to have a tax that they have to pay. In 2011 and 2012, good news. State tax has been lowered from 45 to 35%. The limit is $5 million. If you were to pass away in 2010, you can either choose 2010 law or 2011 law.
Okay, so they have the choices here, and that's where your expertise comes in. Anyone who's out there watching this right now, I encourage you to call James and talk to him about this. This is not a subject that's going to take 10 seconds to go over. There is a lot of depth to this, and James is an absolute expert in it. He can help you if you're an agent. He can also help you if you're a personal investor. But one more thing to go before we get out of here today is the gift tax. James, touch lightly on this really quickly for us. Help us understand what happened.
Give tax change. Instead of being taxed at the 55 percentile, it went down just like a state tax to 35%. Here's how gift tax works. You are allowed to give up to as many individuals as you like, up to $13,000 per year. And that's tax-free. Anything up and above, you're subject to whatever the gift tax rate is, unless you put it into your lifetime exemption. Your lifetime exemption was $1 million in 2010. That has increased to $5 million. So it'll be interesting to see what happens for the next 2 years in terms of gift tax. Are people going to dip into the $5 million because we don't know what's going to happen in 2013? Do people want to give me $13,000? I'd really like it. I think you would as well, Greg.
I'll take 13.
That doesn't even dip into the $5 million. But there were changes that went in our favor. It'll be interesting to see how people react.
You guys, let's talk to James. Best phone number for everyone to contact you.
415-640-0794.
And again, as always, guys, Greg McDaniel. You can reach our team with any other real estate questions about investing or buying or selling your personal residences anywhere in the state of California. Our number, 925-838-4300. Thanks for your time. We'll see you on the next episode.